the rules of debit and credit, and how we can possibly keep these straight. This video is in response to a question I had emailed that asked if I had any tips or tricks on how to remember the rules of debit and credit. I give this this advice in my live classes, and I thought I would make a video for my online classes so they can benefit from this as well. Now let's take a step back first and remember our accounting equation. Remember, assets equal liabilities plus equities. And yes, there is a reason why we express the accounting equation this way. We don't say liabilities plus equity equal assets. We don't say liabilities equal assets minus equities. Though these are important properties to keep in mind, when we express the accounting equation, we generally say assets equals liabilities plus equities. Now, a quick rundown of these account categories and some examples. Assets are, of course, economic resources that provide a future benefit to the company. Some examples of assets, of course, cash. Cash is our number one thought of asset. Accounts receivable. This is when we sell something to a customer, but we have not yet received cash. We have sent them a bill. This is still an asset because this person owes us money. Notes receivable, prepaid expenses, land, buildings, equipment, furniture, and fixtures. All of these are economic resources that will provide a future benefit to our company. Our next account category are liabilities, and these are something that we owe to a third or an outside party. Examples of this would be accounts payable. Remember in our previous example we had accounts receivable. We have sold something to someone and they owe us money. This is we're on the other side of that transaction. We have purchased something from one of our vendors and we have received a bill, but we have not yet paid them. We owe them money. We have incurred a liability. Other examples are notes payable and accrued liabilities. And our final category, stockholders or owners' equity, are our owner's claim or our insider's claim to our assets. Examples of this include common stock, retained earnings, dividends, revenues, and expenses. Retained earnings are, of course, the result of revenues minus expenses. Hopefully we have more revenues and thus positive retained earnings. Dividends are monies we cut to our stockholders, and of course common stock we issue to our stockholders when they become stockholders or owners of our company. Now let's take a look at the T accounts. T accounts help us analyze transactions and assist us in determining the ending balance. Now I'll be honest here, when I was an undergrad, I did not like doing T accounts. I saw it as extra work. I have to journalize these entries anyway. What's the point of doing a T account? Well, now that I'm on the other side of the learning desk, T accounts are fantastic. They're a terrific visual aid to show you exactly what you're doing with these accounts and how the ending balance is determined by looking at debit and credit. And in the end, like I'm going to show you, it really helps us keep these rules of debit and credit straight. And like I say, the T accounts are really going to help us keep these rules of debit and credit straight. When we talk about debits and credits, we're talking about increases and decreases. An account will either be increased by a debit entry or by a credit entry, and of course that's dependent on its account type. Debits and credits are neither good nor bad. They simply perform differently based on which account they're posted in or which type of account they are applied to. Now here are our basic rules of debit and credit. Remember, the type of account dictates the increase and the decrease side. Debits are always on the left-hand side of the T account. Credits are always on the right-hand side of the T account. Increases are recorded on one side. Decreases are recorded on the opposite side. And again, this is dependent on the type of account. Assets, for example, are increased with a debit entry and decreased with a credit entry. Notice on the other side of the equal sign, this is reversed. Liabilities are decreased with a debit entry and increased with a credit entry. And stockholders' equity is also decreased with a debit entry and increased with a credit entry. but there are a few special cases in stockholders' equity. We need to keep in mind a couple of special cases within stockholders' equity. Stockholders' equity, unlike assets and liabilities, has accounts that may have a normal debit or a normal credit balance. For example, revenues increase retained earnings. Retained earnings has an increase effect on stockholders' equity and has a normal credit balance. Therefore, revenues must have a normal credit balance. Well, expenses have a normal debit balance because expenses work against revenues. So we need expenses to have the opposite effect on stockholders' equity than do revenues. Same with dividends. Dividends are a decrease in stockholders' equity, so they have a normal debit balance. Expenses decrease stockholders' equity, and they will have a normal debit balance. So let's first consider our equity accounts in our T account format. Remember, equities increase with a credit entry. When we sell stock, we will increase common stock, an equity account, and we'll credit that account to signify that there are common stock outstanding. When we earn revenue, we will increase retained earnings, and this increases those equity accounts by crediting them. Now, when we incur expenses or pay dividends, we increase those accounts by debiting them. This means we decrease equity because those debit entries work to decrease equity. And so now we have our complete rules of debit and credit. Notice at the top our accounting equation, assets equals liabilities plus stockholders' equity, but we have broken down stockholders' equity into its 5 components. Assets, of course, increase with a debit entry and decrease with a credit entry. Again, on the other side of the equal sign, liabilities decrease with a debit entry and increase with a credit entry. Now, like we've seen with stockholders' equity, we have to break this down into its 5 components, but in general, it operates the same way. Increases with a credit entry and decreases with a debit entry. Common stock increases stockholders' equity, and we increase common stock with a credit entry. Retained earnings increases stockholders' equity, so we credit to increase retained earnings. Revenues increase stockholders' equity, so we credit revenues to increase them. Expenses and dividends, though, decrease stockholders' equity, so they are increased with a debit entry. And this brings us to the normal balance of an account. Now, the normal balance of an account is also what increases the account. Remember, accounting is all about record keeping, and that's really what kind of separates it from our checkbook, if anybody still carries a checkbook and actually keeps up with it and balances it. Accounting, by contrast, is more interested in keeping the record of the transaction. So, in general, we are increasing account balances. And really the best way to think about this is in the term of an asset. Assets always have a debit balance. They always have a positive balance. And I know I don't like to talk about positives and negatives, but think about the asset account equipment or vehicle, let's say a truck. Is it possible to have a credit balance in a truck account? Is it possible to have a negative truck? No. Assets are always debit balances. At worst, they have a 0 balance, but they will always have a debit balance. Assets increase with a debit entry and always have a debit balance. Liabilities, on the other side of the equal sign, are increased with a credit and normally have a credit balance. Are you ever going to have a debit balance in an account where you owe someone? No, that doesn't make sense, right? That means they owe you. Liabilities will always have a credit balance, and they are increased with a credit entry. So how are we going to remember all of this? I recommend using a phrase, along with our knowledge of T accounts and how they operate, and remembering our normal account balances. Remember, on a T account, debits are always on the left-hand side, credits are always on the right-hand side. The normal account balances tell us what happens to these accounts when we debit or credit them. Assets have a normal debit balance and are increased with a debit entry. Expenses have a normal debit balance and are increased with a debit entry. Dividends have a normal debit balance and are increased with a debit entry. On the other side of the T account, liabilities have a normal credit balance and they are increased with a credit entry. Retained earnings have a normal credit balance and are increased with a credit entry. Revenues have a normal credit balance and are increased with a credit entry. And common stock have a normal credit balance and they are increased with a credit entry. And finally, the phrase, "After eating dinner, let's read raunchy comics." I find this phrase is ridiculous enough that my students remember it, and it's an excellent way to keep straight the rules of debit and credit. If you remember our T accounts, the debit side is the left-hand side, the credit side is the right-hand side. In the sentence, "After eating dinner, let's read raunchy comics," after eating dinner is on the left side of the comma and belong on the left side of the T accounts. Let's read raunchy comics are on the right side of the sentence and belong under the credit side. After, of course, stands for assets, eating for expenses, dinner for dividends, let's for liabilities, read for retained earnings, raunchy for revenues, and comics for common stock. Just remember the sentence, "After eating dinner, comma, let's read raunchy comics," and you can always figure out the correct way to post debit or credit entries.